Imagine America in the 1920s, a dazzling era of prosperity, jazz, and boundless optimism. The Great War was over, technology was booming, and fortunes felt limitless. Cars filled the streets, radios brought entertainment into homes, and for the first time, ordinary Americans were actively participating in the stock market. This wasn't just about investing, it was a cultural phenomenon. Everyone, from factory workers to society dames, was buying shares, dreaming of easy wealth. The market seemed to climb forever, promising a golden age that would never end. The lure was irresistible. Buying on margin, borrowing money to buy stocks, became commonplace. Brokers encouraged it, banks facilitated it, and the soaring stock prices seemed to justify every risk. People poured their life savings, even their future earnings, into the market, convinced they were on a guaranteed path to riches. The financial system, however, was built on an increasingly shaky foundation of speculation and debt. While the party raged, few noticed the cracks forming beneath the surface, the whisper of danger in the seemingly endless boom. Behind the glamour, a more precarious reality was taking hold. Factories were overproducing goods, and wages hadn't kept pace with the rising cost of living, or indeed the frantic pace of stock appreciation. Farmers, already struggling through the decade, faced collapsing prices and mounting debt. A significant portion of the nation's wealth was concentrated in the hands of a few, while most Americans lived paycheck to paycheck, their speculative investments often their only hope for upward mobility. The economy was a house of cards, tittering precariously. Then came the day the music stopped. October 24th, 1929, Black Thursday, saw the market plunge. Brief recoveries brought false hope, but the true reckoning arrived on Black Tuesday, October 29th. Panic gripped Wall Street as millions of shares were dumped and prices plummeted. Fortunes vanished in hours. The ticker tape couldn't keep up. The dream of eternal prosperity shattered, replaced by a stark, terrifying reality. It wasn't just paper losses, it was the collapse of an entire era's defining illusion. Initially, leaders tried to reassure the public. President Herbert Hoover and prominent financiers downplayed the severity, hoping to stem the tide of fear. They spoke of the fundamental soundness of the economy and promised a swift recovery, but the damage ran deeper than anyone publicly admitted. Confidence, once the invisible fuel of the market, had evaporated. The initial shock gave way to a creeping dread as people slowly realized that this wasn't just a market correction, it was something far more profound and destructive unfolding.
The stock market crash was merely the opening act. The real tragedy unfolded over the next few years as businesses shuttered their doors, unable to sell products to a suddenly impoverished populace. Demand plummeted, factories stood idle, and unemployment soared. This wasn't a quick fix. It was a slow, agonizing grind. The intricate web of the American economy began to unravel thread by thread, affecting every city, every town, every family, with relentless and unforgiving force. The Great Depression was truly beginning its cruel reign. As jobs disappeared, so did the ability of millions to pay their debts. Mortgages went unpaid, foreclosures skyrocketed, and family farms were lost. The ripple effect was devastating. With less money circulating, businesses cut even more jobs, creating a vicious cycle of economic contraction. Desperation began to set in, replacing the earlier optimism with a gnawing fear for survival. The fabric of communities, once vibrant and hopeful, started to fray under the immense and unrelenting pressure of widespread financial ruin. The most insidious danger, however, lurked within the banking system itself. Before federal insurance, individual banks were fragile institutions. When a local business failed or a significant borrower defaulted, the bank holding their loans could collapse. This began in rural areas, where small, independent banks, heavily dependent on local economies, were the first to buckle. The news, though localized at first, created unease. Each failure, though seemingly isolated, eroded public trust, planting seeds of doubt in everyone's mind. For millions, a bank failure meant total ruin. There was no safety net. Every penny saved, every dollar earned could vanish overnight. People who had worked their entire lives, meticulously saving for retirement or their children's future, found themselves utterly destitute. The loss wasn't just financial, it was a profound blow to dignity and hope. The fear of losing everything became a powerful driving force, overshadowing all other concerns, breeding a desperate desire to protect what little remained against an invisible, all-consuming threat. As word of bank failures spread, a chilling phenomenon began: the bank run. It started quietly, with a few anxious depositors asking for their money. Then more people joined. The logic was simple, yet devastating. If you thought your bank might fail, your only recourse was to withdraw your cash immediately. But banks operate on fractional reserves. They don't hold everyone's money in their vaults. A large-scale demand for cash could quickly overwhelm even a solvent institution, turning fear into a self-fulfilling prophecy of collapse.
By the early 1930s, these runs were no longer confined to small towns. Major city banks, once symbols of stability, now faced relentless pressure. Long queues snaked around street corners, filled with worried citizens demanding their deposits. Tellers frantically counted out cash, while bank managers desperately tried to call in loans or secure funds from other sources. The atmosphere was often quiet, tense, and filled with a collective dread. Each withdrawal chipped away not just at reserves, but at the very foundation of financial confidence. Many banks simply couldn't withstand the onslaught. Even those with solid assets could not convert them to cash fast enough to meet the sudden, overwhelming demand. Doors were locked, shutters pulled down, often without warning. A small sign on the door declaring a temporary closure shattered countless lives instantly. Thousands of banks failed between 1929 and 1933, destroying billions in savings. The financial system was hemorrhaging, and trust, the lifeblood of banking, was draining away at an alarming rate. The human toll was staggering. Millions were jobless, homeless, and hopeless. Families scavenged for food, children went hungry, and the proud American dream felt like a cruel joke. Makeshift shantytowns, derisively named Hoovervilles, sprang up in parks and vacant lots across the country. Bread lines and soup kitchens became grim fixtures of urban landscapes. The fear of losing what little you had, or never recovering what was lost, became a constant, soul-crushing companion for an entire generation, reshaping their outlook forever. President Hoover, though initially hesitant to intervene directly, eventually took action. His administration established the Reconstruction Finance Corporation, or RFC, in 1932. The RFC was designed to provide emergency loans to banks, railroads, and other businesses to prevent further collapses. It was a significant step, but it came too late and was too limited in scope to stem the widespread panic. The public needed a stronger, more direct assurance that their deposits were safe, not just a bailout for institutions. Despite the RFC, the crisis deepened. By the winter of 1932 to 33, the banking system was on the verge of total collapse. State after state declared bank holidays or limited withdrawals, essentially freezing assets. The country faced an unprecedented financial paralysis. The outgoing Hoover administration and the incoming Roosevelt team grappled with an economy in freefall, yet no clear path to recovery seemed apparent. The nation held its breath, waiting for a radical solution that seemed increasingly out of reach. On March 4, 1933, Franklin Delano Roosevelt was inaugurated as president. The air was thick with desperation, but his inaugural address offered a glimmer of hope. "The only thing we have to fear is fear itself," he declared, a rallying cry for a demoralized nation. Roosevelt immediately understood that restoring confidence was paramount. His New Deal wasn't just about economic programs. It was a psychological campaign to convince Americans that their government could and would pull them out of this abyss of despair. Upon taking office, Roosevelt faced an immediate, monumental challenge. Many states had already declared bank holidays, and the entire national financial system was effectively paralyzed. On the eve of his inauguration, the New York Federal Reserve faced an unprecedented demand for gold withdrawals, signaling an imminent, total collapse. Without swift, decisive action, every remaining bank could fail. The country held its breath, realizing that the new president's first moves would define his entire administration and perhaps the nation's fate. FDR's first major move was radical. On March 6th, he declared a nationwide bank holiday. For 4 days, every bank in the country closed its doors. This wasn't to seize assets, but to stop the bleeding, to calm the panic, and to give the government time to assess each institution. Then, on March 12th, he delivered his first fireside chat, a direct address to the American people via radio.
His calm, reassuring voice explained the situation, building trust one living room at a time, promising a path forward. Within days, Congress passed the Emergency Banking Act. This swift legislation provided the framework for reopening banks deemed sound and reorganizing those that weren't. Teams of auditors, supported by the Treasury Department, raced against the clock, inspecting thousands of banks. It was an unprecedented mobilization of government resources. This temporary closure, far from signifying defeat, was presented as a strategic pause, a necessary intervention to separate the strong from the weak, preparing the ground for a secure reopening. When the banks reopened on March 13, 1933, the public's response was remarkable. Trust, slowly but surely, began to return. People lined up again, not to withdraw money, but to redeposit it. The calm assurance of FDR's voice, combined with the visible action of the government, had worked a miracle. The sheer scale of the turnaround was astonishing. This wasn't merely a political victory, it was a profound psychological shift, a collective sigh of relief that saved the American financial system from total annihilation.
But Roosevelt knew a temporary fix wasn't enough. The underlying vulnerability of individual bank failures remained. The idea of insuring deposits had been debated for decades, often dismissed as impractical or even socialist. However, the raw trauma of millions losing their life savings during the Depression provided an undeniable impetus. It was a radical concept, a government guarantee that your hard-earned money, no matter what happened to your bank, would always be safe. This was the true revolutionary answer to the fear. So, in June of 1933, Congress passed the Banking Act, which included a provision creating the Federal Deposit Insurance Corporation, or FDIC. This new government agency was charged with insuring bank deposits up to a certain amount, initially $2,500. It was a groundbreaking measure, designed to prevent future bank runs by eliminating the very fear that caused them. The FDIC wasn't just a bureaucracy, it was a promise, a tangible assurance to every American that their savings were now backed by the full faith and credit of the United States. How did it work? Member banks paid premiums into a federal insurance fund. If a bank failed, the FDIC would step in, using that fund to pay back insured depositors directly. This simple yet profound mechanism transformed banking. Before FDIC, a bank's failure meant total loss. After, it meant a guaranteed return of your money up to the insured limit. This removed the incentive for panicked withdrawals, breaking the devastating cycle of fear and self-fulfilling prophecies that had plagued the system for so long. The effect was immediate and profound. With the FDIC in place, public confidence surged. People no longer feared losing their life savings. The silent, destructive runs on banks became a relic of a bygone era. Money which had been hoarded under mattresses or in coffee cans slowly flowed back into the banking system, revitalizing lending and investment. The FDIC didn't just save banks, it saved the trust necessary for a modern economy to function, allowing capital to flow freely again and rebuild the devastated nation. Today, the FDIC remains a cornerstone of America's financial stability, insuring deposits up to $250,000. Its creation stands as a testament to radical reform born from desperate crisis. The Great Depression taught us a hard, indelible truth. An economy's strength isn't just about factories or farms, but about the fragile, indispensable confidence of its people. The silence that broke the banks ultimately forged a shield, reminding us that trust, once shattered, is the most valuable currency of all.